So hello guys, welcome back to the part 2 of the price action trading course, and in this part we are going to be discussing about various basic chart patterns which will help us in trading the trend. And if you haven't watched part 1, I suggest you to go and watch that because it will help you in understanding this series better. So let's just get started with what are chart patterns. So chart patterns are basically the patterns which are formed in the charts and which help us to know in which direction the stock or the asset will go in the future. It helps us to predict the future. So before starting, I would like to tell that no pattern is 100% accurate and no pattern is every time correct. So we have to trade according to our risk management. The chart patterns just give us a view of the market, but to take a trade we need to have at least 2-3 confirmations, as I always say. So let's get started with the first pattern. So our first pattern is the symmetrical triangle pattern. So in a symmetrical triangle pattern, as you can see, it is a continuation pattern, and the pattern is formed by two converging trend lines that are symmetrical in relation to the horizontal line. So as you can see, this resistance trend line and the support trend line, they are parallel in relation to the horizontal line, which is the price line. The top line acts as a resistance and the bottom line acts as a support. This is a neutral pattern and we have to wait. This is a neutral pattern and we have to wait for retest after the break, as it can give a breakout any side. It can either break out or it can break down. So now let's talk about symmetrical pattern in a real chart. So as you can see in this stock, there are no trend lines drawn, so I will draw as you can see that we have to identify the symmetrical triangle chart pattern. And as you can see here, this trend line is acting as a support and this trend line is acting as the resistance, and when it was broken we got a very good target. So now let's discuss about our entry points and our stop loss. So in every pattern our stop loss is going to be at the point where our pattern gets invalidated. So as you can see that here, as you can see, we had a fake breakout because the volumes were very low. We have to wait for the confirmations with volumes. As you can see in the real breakout, the volumes were very high and we got our target, and the target was achieved. So and our stop loss will be over here, because if the stock is breaking on the upside, if it comes back in the zone or if it breaks downside, then our trade will be invalidated and we will have to get out of the trade. Now let's get to the second pattern, which is the descending triangle pattern. So the descending triangle pattern is formed in the downside as in the downtrend, and it indicates the continuation of a downtrend. This pattern clearly indicates that the market is moving lower as the lower highs are formed heading toward the support line. As you can see that the market was taking support and then resistance from this line and making lower lows and was making lower highs over here and finally broke down in the downside. Now let's talk about a real example of descending triangle pattern. So as we can see that in this zone the stock was taking support, and over here it was taking resistance from the zone. It gave a fake breakout, but as you can see the volumes were very low. I always trade with the volumes, and in the breakout and the breakdown the volumes were very high. Now let's discuss about the entry exit points. So our target will be of the size, so our stop loss will be where the chart pattern gets invalidated, so it will be over here. As you can see that we are getting a very good risk to reward ratio of 5.22, and our target will be equal to the size of the pattern here. So let's, as you can see, exact target was hit and our pattern worked correctly in this scenario. The next pattern is the opposite of the descending triangle pattern. So this pattern includes a triangle with a resistance and a trend line of higher lows. As you can see, higher lows are being formed over here, and the resistance does not allow the chart to move more upward. Higher lows show that the buying pressure has increased and higher lows have been formed. So higher lows have been formed and they are indicating that the buying pressure has increased, and and then finally the stock gives a breakout on the upper side. Now let's talk about a real example of the ascending triangle chart pattern. So as you can see, our support trend line will be over here. You can see higher lows are being formed, continuous higher lows are being formed on this trend line, and the stock is taking resistance from this zone, and as you can clearly see that the stock gave a very good breakout with a gap up opening, and our target was achieved very nicely. As you can see, we even took an entry from this side where the market just opened, and our stop loss would have been over here because after a huge gap up opening. And now let's check our target size. As you can see that we got more movement than our target size, so it was a very good trade to take. Now the next pattern is the falling wedge pattern, and the falling wedge pattern is characterized by a chart pattern which forms when the market makes lower lows and lower highs with a contracting range. This pattern is similar to the triangle pattern, but in this pattern the market is moving in a contracting range. As you can see that the market was an initial uptrend, then it was taking retracement from these zones, and then it finally gave a breakout on the uptrend. Now let's talk about a real example of the falling wedge chart pattern. Now let's check out this chart. As we can see that the market was taking rejection from this zone and was forming lower highs continuously on this trend line, and was taking support from this zone, and the stock was bouncing back from this side, from this trend line. So and it gave a breakout. Now let's check our entry points. So our stop loss would be over here, because if the chart pattern gets invalidated, then we will have to get out of our trade. And as you can see, a very good risk to reward ratio of 5 was hit over here, and this was also a very nice trade. Let's get to our next pattern, which is the rising wedge pattern. In this pattern, the pattern appears as an upward sloping price chart featuring two converging trend lines. As you can see that these are two converging trend lines, and it is usually accompanied by descending trading volume breakout confirmed once it breaks support trend line and it goes downward. Now as we can see that here the market is taking resistance from this zone and continuous support from this zone. We could have traded this chart according to the symmetrical chart pattern also, but here I am trying to show the rising wedge pattern. So let's check our entry price and our target. Our stop loss will be over here if our chart pattern gets invalidated, and our target will be over here. And as you can see perfectly, our target was hit with a good risk to reward of 1:8. So as you guys can see that chart pattern trading makes trading very easier for us to identify the trends. So we should always take help from chart pattern before entering some trades. The next pattern is a flag and pole pattern, and in a flag and pole pattern, a that flag and pole pattern, this one is basically a bullish pattern. And this bullish flag confirmations are found in stock with strong uptrends which are already in an uptrend. They are called bull flags because the pattern resembles a flag and a pole. So this is a pole and this is the body of the flag. So this is a flag, and then it gives a breakout on the upper side. Let's consider a real example of the flag and pole pattern. As you can see here, this zone can be considered as the pole of the flag, and this will be the body of the flag. And the breakout, you can see for yourself what an amazing breakout was given. And because cryptos are volatile and chart patterns helps us in identifying the trends in crypto and makes trading easier for us. The next pattern is the inverted flag and pole pattern, which is the exact opposite of the flag and pole pattern. In this pattern, the flag pole forms on a vertical panic price drop as bulls get blindsided from the sellers, then a bounce back that has parallel upper and lower trend line. And you can see that the bears overpowered the bulls here and the stock fell, and then it was accumulating in this range, and then finally it gave a breakdown. Now let's get to an example of the bearish flag pattern, which is the inverted flag pattern. So you can see here the price was falling vigorously, and then this can be considered the pole of the flag. This will be the body of the flag, and this will be the breakdown. Let's check our entry and exit points. Our exit point will be over here if the pattern gets validated. If the pattern gets invalidated, and as you can see that our target was hit with a risk to reward of 1 is to 7. So as you can see, in each and every trade which we are taking, we are getting very good risk to reward ratio according to the chart patterns, with confirmations with volumes also, and we are trading the trend. Always while trading we have to remember one thing, that the trend is your friend until it bends. Let's get to the next pattern, which is the cup and handle pattern. In this pattern, the price movement of a chart resembles a cup followed by a downtrending price market. As you can see that the price must be falling, then taking support, then rising, then taking support, then rising, forming a cup, and then forming a handle, and then finally giving a breakout on the upper side, and the breakout gets confirmed with the resistance or the neckline is broken. Let's get to an example of cup and handle. As you can see that in this stock, a cup and handle pattern is being formed, and after the breakout our target was achieved, and this was a swing trading, and this was a swing trade which I took, and I holded it for 20 days. So in swing trading we have to hold our trades from days to weeks or months. So swing trading done right over here according to the chart pattern, with an increase in the volumes also. As you can see that the breakout was confirmed with the spike in volumes. The volumes were dry after the breakout, but the breakout was confirmed, and then the our stop loss was almost going to get hit. But that is why I always say that we have to place logical stop losses and not tight stop losses, because if you are placing tight stop losses, then it has a greater chance of getting hit. So it's better to have a logical stop loss instead of a tight stop loss. Next pattern is a basic range breakout pattern, which can give a breakout on either side. This pattern is a simple support and resistance breakout. The price is taking continuous support from the support zone and continuous resistance from the resistance until it breaks out either way. In this pattern the price is moving in a zone, and then it finally breaks out or breaks down and take. If the resistance is broken, then the old resistance will act as new support for the price. Let's talk about a real example of the range breakout. As we can see here that the price was continuously moving in a zone, and then finally it gave a breakout, and then after giving a breakout, the old resistance line will act as a new support, and then the price was moving up. Then the price gave breakout of another zone, and then after giving the breakout of this zone, the price also broke out this zone. Then this line will act as support. After that the price broke this support, and then again took support. This stock is always moving in a zone, so this was the best example of the range breakouts. ECS always gives range breakouts either on the upside or on the downside, as you can see. So thank you guys for watching this video. I hope you learned something new from this video. That's all from my side. Before ending this video, I'd like to give some tips. I'd like to give you some important points, that we should always identify the trend on a higher time frame, because a higher time frame gives us a confirmation, and we should enter our trades on a lower time frame. Second is, we should always trade with a stop loss, and a stop loss should always be logical, it should never be tight. And the third one is that the size of pattern does not matter, as long as you can identify the right trend and trade according to it. As you can see here, the flagpole pattern, this pattern looks very small and some people might even laugh on it, but I was able to identify it, and I was also able to trade it. So that's all from my side. Thank you for watching this video. If you liked it, please subscribe to the channel and give a thumbs up to the video.